All right, good morning, everybody. TGIF, huh? So we made it to the end of the week. We got OpEx today. Triple witching is far behind us. Don't have another one of those for a while, but just a regular OpEx is enough. Asia kicked everything off last night, really bullish. That dried up into the European session, which turned us flat, and now trying to unwind some of the Asian bullishness. So just a cycle through the world. You're going to want to keep your eye on Europe's close today, right? They shut down the bullish run, and once they're done, the market could change direction simply because their influence is no longer there. So keep your eye on the markets after Europe's close. If you're sitting there thinking, oh, I don't know when the hell they close, yeah, I get it. There's this really great website that's free. It's called tradinghours.com. Doesn't cost you anything. You don't need an account. If you go over to this place, you can see markets from around the world. It'll show you whether they're open right now or closed, when they open, when they close, and if they have any holidays, whether or not they are on a holiday. This is really useful to try to find out what's going on in the overnight hours. If liquidity is off or you just see some unusual behavior, one of the first things you want to check is, did they even open? Right? Thinkorswim has something like this built into it, but it doesn't actually check to see if the markets are open. It just knows what hours those markets are supposed to open and assumes if it's a weekday in those hours that they are open, and it never checks to see if it's a holiday or anything like that. So it's best to use a site like this so that you can verify. So you can use that site to make sure you know when Europe closes. And you're going to want to do that today, because when they close, we could see a change in market dynamics. NASDAQ up around 0.5%. Small caps at 1/4. I was just reading an article that talked about the small caps dominance in 2026 so far. Um, it comes and goes, right? It comes in waves. And even the Dow has outperformed so far this year. Japan down 1/4%. China closer to zero. We're kind of in a holding pattern at the moment. The S&P and the Nasdaq are off by around 0.5% again. It's been kind of the theme this week. So keep your eye on those two to see if the S&P is going to catch up or if the Nasdaq is going to catch down. The numbers that we're going to get today from the various economic events don't stand out with any wide discrepancies. Nothing here looks to be overly impactful. So I'm more focused on OpEx today than any of these. Still don't want to discount it. When you've got Fed speakers out there chipping their teeth, then we could see gotcha moments. They can be misquoted, foot and mouth, all kinds of things can go wrong when you have the opportunity for Q&A and public speaking. This is FX Street. It is showing industrial production as a potential high spot, but with the numbers so close together, it likely isn't. So worst case scenario is the forecast is way wrong. Markets are off sides and ends up having to chase. Then we could see some shenanigans from that, but otherwise, it's likely to be a very dull Friday. It's like Groundhog Day, huh? It's the same thing over and over and over and over again. Just not getting any change. Can't seem to break this rhythm. Yeah, that comment about tariffs on semiconductor firms that do not have U.S. production was part of the reversal yesterday. That was from the Commerce Secretary Lutnick, which kind of highlights the foot and mouth, shenanigans we're talking about today for risk. We got moderate risk looking at the White House and the administration. I believe there are plenty of YouTube videos that explain it. Spot Gamma's got a few. I'm sure Trading Volatility has a few. If you can't find one, then I'll make a video. But it's a it's a pretty simple process, right? Where you just go in and make a new indicator and you paste the code in there and apply it to your chart. Then the next day, you wipe that code out and put the new code in and apply it to the chart. And you just save that one indicator and just keep rewriting the code every day. So quick dip below the 10 this week. We're back above it. Hanging out around the volatility trigger, call wall overhead, put wall in the same spot, 0 gamma down below. We got a nice stack here between the 20, the 10, the 3, and the 3 week. Right, so we could just got a lot of stuff all wrapped up here. And we're crossing back and forth through all of it. So we don't want to look at it as any form of support or resistance or anything like that. But when you're around that 10, price can hold out around that level. And of course, you get all this violence, right? See these big wicks on each side. That is part of the trouble that we're dealing with. And of course, we're still IX10 sitting within this range. It's not an overly wide range, but it's wide enough to keep us contained. If we're considering reciprocation, then the distance we expanded to the downside now is owed to us on the upside. And if we're going to continue in this megaphone pattern, then the idea would be that we just get one of those wick type bars up here and then maybe set a longer bar. This one was the first one, and it wasn't very long at all. Then we exceeded to the downside and we made it even longer. On the next break, we could exceed that and go even farther again, which is where the megaphone gets its shape, right? When you start broadening out more and more and more. Until it breaks. So at the moment, it at least owes us 70.50 on a top side breakout. But we wouldn't be looking at this for like a breakout and run. It doesn't owe us that yet. It will eventually. Since we are IX10, we're going to eventually end this range and we'll expand at that point one direction or another. We had another version of it back here, which this one kind of got ugly and probably isn't the best example, but we set the range, stayed inside of it. Then we got the fake break and the run in the other direction. It's like a draw and raid. So draw everybody in, raid liquidity, and run it the other way. Probably not a really good example, but at some point this range will end and we will begin to expand again. And until that happens, this violence is just going to get worse and worse, right? That's why the range is getting bigger, the average daily move is getting wider, and yet we're not getting anywhere, right? We continue to close within the boundaries. Today's a pretty good gift so far. We are clearly inside of yesterday's range and solidly inside of our own Globex range. GTFO, get out of the box before we do anything else. And it's likely that today looks a lot like yesterday. So if you liked all of that until Lutnick opened his mouth and sent us to the downside, that sideways, choppy, nasty behavior, well, cheers. You're going to get more of it today, very likely. Overnight volume running at 55. That's just about where the average is. So from my perspective on that, we're exactly where we should be. There was a decent amount of overnight trading without it being too heavy or too light. Maybe kind of Goldilocks, right? All right, now this market maker move, you have to kind of take it under advisement that on OpEx days, you'll often see that. And unfortunately, that for us, anyways, unfortunately for us, we don't know if that's a true market maker move or if it's just there because it's OpEx and they're moving their positions. Now, I was looking at the dealer positioning this morning and how much it owed and what the imbalance was, and they're they're putting in some work this morning, but with that 0-day flow, they're obligated to get it moved, preferably the sooner the better. So unfortunately, it's just the way that it is on OpEx days. And if this was triple witching week, we would probably see that label every day of the week for the whole week. It's just not going to be very helpful to try to identify if they're adding additional hedges. It's just the way it is. It's unlikely that they're adding any hedges today because we just looked at the calendar and there wasn't really anything worth hedging against. But we can't say 100% for sure. So that sucks. We haven't reached either edge of the ADR today, so base case argument is that we just make our way to one side or the other, or both, and that we stay inside the range. That range is the average, right? It is the norm. Think about it. If every day the same thing happens over and over and over, day after day after day, and it's just the same thing over and over and over, well, what do you think today's going to do? The same thing it did yesterday. Why? Because that's the average thing. It's what continues to happen again and again and again and again. Well, this isn't any different than that. So if that's the average daily range, then that's what we anticipate, especially when it's a boring, sleepy day, no headlines, no economic events of note, anything really big, and it's an OpEx Friday into a weekend, into a long weekend, I believe. Isn't that right? Aren't we closed Monday? Or am I getting my days mixed up? So there's no anticipation of getting outside of this box today unless we get some headlines or some news that we're not seeing at this point, right? And that would be the unknown unknown as opposed to a known unknown. A known unknown would be CPI, PPI, non-farm payrolls, some known event with an unknown outcome versus some unknown event with an unknown outcome. So base case, we're going to sit inside that box. Today's floor pivot is higher than yesterday. That's bullish. Price opened at or above. That's also bullish. Since we did open at or above, we've already hit it, so it's not a missed daily pivot, but we barely scratched it. And if we're thinking about what it would owe us, I would say that I'd like to see it hit again. Doesn't have to hit it, but we can't call it a missed daily pivot because it isn't missed. It has been hit. And we would want to consider the S&R levels for today. We haven't reached R1 and we haven't reached S1. Both of those are really close to being inside of yesterday's range. R1, maybe by a tick or two, could be outside of the range, but otherwise, they line up with yesterday's high and low, staying inside the boundaries. We don't even need a breakout to get to them. Another reason to believe that there's no expectancy of a breakout today. All right, on the week, we've developed a decent distribution. It's not exactly a P-shape distribution simply because the lower part isn't as thin as we would want it to be for that. But it isn't quite the classic D shape either, right? The D shape would be more uniform, and we're kind of stacked against the highs up here. So this is our range. It is what we need to get out of, and there's no reason to think that we're going to be able to accomplish that today, right? Clock's ticking. We're running out of time. We're going into a long weekend. So 69.92 cog line lines up with the value area high of last week or really close to it. And this high volume node back here, it's kind of the last line of defense because it does get thinner after that. So we could move more swiftly if we were to expand outside of that. But we would still be within the value area of the current week. And there's just no expectation of getting more than that unless something completely changes the narrative. Ten-day, 30-minute volume profile and TPO. The candles that made the current point of control, we're not going to get into them for another week. So the only way that we're going to see this point of control move right now is if we were to build out another level and challenge it to bring it down or up. We got a lower level built out, that 69.55, but one, we would have to go down there, and then two, we'd have to hang out there and build that volume out and bring it down. Technically, it's possible to do, but that would be second guessing the market and looking for it to do something specific rather than just playing what we get. So for now, this is our world, and it's not necessarily a bad range. It's a little tight, and it certainly does highlight the new reality for us. When we come back in on Tuesday, if we haven't yet left this range, this is going to be our new reality. It's even tighter, right? This is what we've been developing, and you can start to see the megaphone pattern developing even now. And this is what we got to resolve right there. 70.32 on the upside, 69.22 on the downside. We got to solve this. All right, we're done with that POC. We still have the VPOC down here, and we got a new one yesterday. Let's just move it up here for a moment. Now look, I'm just getting it close, right? I don't care to zoom in and get it down to the absolute tick. Getting point close is close enough for me, but you do you. You want to zoom in on that thing and dial it into the nearest tick, yeah, you have fun with it. Otherwise, that's good. It's close enough. So if we make a move to the upside today, we've got yesterday's point of control to deal with. Remember, we don't look at that as a support or resistance level, just as an area of interest and a potential place to see elevated trading volumes. That could turn into resistance, absolutely, but it doesn't have to be. Watch the tape, look at the market participation as we even get near that level. See if they start pulling and stacking around there, and then if they defend that level, you should see it in the tape as we come up into it. If we break the RTH low of yesterday, we of course want to aim for the low of yesterday, but I would keep 69.42 as my downside target. 42 is an old school cog line we don't use anymore, and it is close enough to yesterday's low that it would work. Plus, it's the major gravity point for the week on the downside, because there's nothing else down there, right? If you look at the volume profiles for Monday, Tuesday, Wednesday, and Thursday, we got 3 stacked across the highs, and it's the only one down there, right? So that's going to be the major level of defense on a downside break. It will be the target that I aim for if we break down. All right, we got a preview of next week's range, but it's only that, right? It's only a preview because it's not set in stone yet. Still, every week, one of the things that I like to do is measure this range and compare it to the current week that I am experiencing, right? So this is the week that we're in right now. Next week is what is being projected. And next week looks a little bit bigger than this week. But hold on, right? Next week's a short week. This was a 5-day week. If you can travel 60 miles in an hour, well, you had a whole hour to do it. What if you only get 45 minutes? You're not going to be able to travel 60 miles, right? You don't have as much time. Well, that range for next week is based on a 4-day work week. And yet it's still bigger than the range that we had this week. So if you still wanted to travel 60 miles, but you've only got 45 minutes to do it, what do you got to do? You got to go faster, right? There is more volatility priced into next week than that range implies. It should be narrower simply because there's less days. And it's not, it's bigger. So there is a lot of volatility being priced into next week's range. If you have never been around and heard me talk about these, you may think it's CPI, PPI, non-farm payrolls, or some other sort of economic event, but that wouldn't be the case, right? Because those known economic events are volatility suppressing events. The range would be narrower if we had, for an example, OpEx next week, or if we had FOMC, which we do, right? The 28th, in that next week? Or is that the week after? That's the next week. 2 more weeks for that one. So it isn't FOMC, but whatever it is, if it's a known unknown, it wouldn't make it bigger. It would make it narrower. FOMC is volatility suppressing. I know it sounds odd, right? First time I heard somebody say that, I thought, what are you, dropped in the head? You ever seen markets move on FOMC day? They move. But the comment that FOMC is volatility suppressing isn't about the day of FOMC. It's about leading up into FOMC. And leading up to it, it is volatility suppressing. So if next week was a known unknown, like CPI, PPI, FOMC, any of those, the range would be narrower simply because of that. And it's not. So why is it so big? It could be that there's an earnings next week that the market is concerned about. It could be all the geopolitical tensions that are going on right now. It could just be that the markets are worried since we've been stuck in this range and we haven't been able to get out of it. Whatever it is, there's something causing the market to price in volatility for next week. And it's not based on one of our scheduled economic events. It also means we're not looking for hurry up and wait next week. We will be looking for expansion next week. So we're just going to keep this range and we will review it on Tuesday when we get back. For today, just to finish out the week, we should close inside this box. I mean, that gray line was last Friday's close, and we've been hovering around it all week. There's really no expectation that that's going to change today. At the bare minimum, we still kind of expect to go up today and close above Friday's close. For the silliest reason, too, just so that the bobbing heads on TV can say that the week closed positive, higher than last week. It sounds silly, doesn't it? But they want to carry that narrative, and that's all they have to do that. Just close higher than last week's close. We're still above the 10-day, barely, but we are within that 0.5% as well. So my little mini collar. This is where we expect volatility to be a bit lighter, and we can see the markets act like we got some form of gravity around us. So we can sit in this zone for quite a while. It's going to take some effort to get out of it. Kind of like getting momentum, put your shoulder into a sticky door. So this isn't bearish, it's not bullish, it's just a correction in time, healing, digesting, whatever words you want to use there. The main thing is we haven't moved too far too fast, and it does not owe us a pullback or a mean reversion in any way. We're around 1.5% above the 10-week. That's fine. It's nothing wrong with that. If we were to get below 1%, then we'd likely gravitate down into the weekly, but we're not there, so no worries. I'm still looking for a higher high here, which I have been looking for a while now, right? Still haven't got that higher high. And I don't want some shady little wick like a used car salesman, right? I want just a full-on punch through the system. So 2.5, 3, 3.5, that'd be great. We don't have it. Still looking for it. We could end up getting a reset first, which means getting back down to 0, underneath 0. Those are still on the table. But at the moment, same answer. We are not overbought. We're not overextended. We haven't moved too far too fast, and it does not owe us a pullback. All right, China's down. The Mag 7 down volume is down. Yes, that's a double negative. China again and again. VIX is down. Really, that's it. And that's not bad, right? China and VIX. That's it. China and VIX. Flip it all over. Look at what's up this morning. What's uranium, nat gas, UFOs, chips, Mag 7 up volume, generic tech. Really, that kind of dries it up right there. We do have quantum and some other versions of Mag 7 that are up, but they're not up enough. So we need a little more out of that. Still, we have the proper sectors for a rally at this point. We just don't have any reason to believe that we're going to get that rally. There's been this unwind of the growth play, right? And so we've been seeing value do really well. And looking at things yesterday, we had not yet turned back the other way. It's not time to buy the mags for a good long play yet. Close. And we may not get that signal until after earnings. Still, we got generic tech, probably some of that older tech. They were talking about Dell and HP this morning on Bloomberg, some of that older tech. And of course, chips and newer things like the basket of UFO stocks, space, solar. So if we are looking for a rally today, it's going to have to come from somewhere other than the Mag 7, or at least with the Mag 7, right? So some solid 0-day flows, maybe something from dollar, commodities, bonds, yields, something. The mags ain't going to be able to do it on their own. All right, so just to wrap it up, we've got our Globex range. You got to get out of that before you do anything else. You got yesterday's RTH. It's the second box. And then you've got all of yesterday, and that's the third box. Now, to the upside, it's just two boxes, our own Globex high and yesterday's high. That's it. To the downside, it's our Globex. It's yesterday inside the RTH, and then yesterday, all of yesterday. Now, we could get some really good price action without getting this breakdown, right? We don't have to get all the way outside of that before we start to see good price. I mean, look at all this. This was really good price yesterday, and this was good price yesterday. But if we sit right here, it's very likely not going to be very good price, right? If we just sit in this, it's just going to be sloppy and nasty. So if you don't want to trade sloppy and nasty, wait for it to get out of that box. It's also likely that inside of this box, it's going to be sloppy and nasty. So if you want really good, clean, tradable signals and patterns and setups, get out of that box at least, which is yesterday's RTH low or yesterday's RTH high. You got the 111 and the 1236, and that could begin the move to the downside, or yesterday's 111 and 1236, and that could participate to the upside. Could. I don't expect it. If we break out of either side, I'm running the reversal off of 111 because there's no reason to anticipate a breakout day today. If we expand below, then, like I mentioned earlier, I'll aim for that downside target of 42, which is basically yesterday's full low, right? So if the 111 fails, this one, if we fail to turn around here and come back in, I'll take that loss. And then I'll just take the short down here to 42. All right. Easy enough. It's a pretty decent Friday, all things considered, because at least it's a two-way street, right? We go to the upside, we got a decent trade. We go to the downside, we got a decent trade. All we got to do is GTFO. So everybody, be careful, be safe, enjoy your long weekend. I'll see y'all Tuesday.